better manner. So lastly, the bench of the companies, performance against the industry can also be considered whether they are performing average or they are performing better to their peer groups. This is how the scorecard can be handled. How the scorecards can be used. This technique can be used by both the companies, public and private companies. Creating a scorecard for a private company is a challenge because not lot of information about the company is not available in the public domain. Incidentally, I was about to join a company as an independent director. When I started finding out that in the web, I could not find much thing. For its balance sheet also, I had to go to MCA. Since I had the ID, so I went to MCA. So it is true that lot of data about the private company is not available in the public domain, but the technique can be used. The scorecard technique is getting adapted to the scoring countries for the sovereign bonds, infrastructure, and the real estate analysis, which they are using, which the government is also maybe using. For example, one can score environmental policy for infrastructure and the commitment countries, and the corruption level can also be taken into the consideration. When we talk of infrastructure, commitment to the net zero can be taken into the consideration. What we are discussing entire thing in the context of a SASB, so I find it is necessary to relate this scorecard with the SASB also. SASB is, we know that the SASB is a baseline framework to help to determine which ESG factors should be on the scorecard, especially those which are financially material for the business. So think of a SASB as a content guide and the scorecard as a measurement tool. For example, when you are evaluating a transport company, with SASB, you can highlight its fuel efficiency, safety, and emission, which are financially material, because emission is going to control its expenditure. If it is fuel efficient, the carbon points. But the scorecard can include the metrics and the question around these topics, like GHG emissions, how many GH emissions are there, how many accidents are happening. So both are required. One alone one cannot help. So one investor has to see not only the valuation of the company, but it has to see the valuation of the company in perspective, and these parameters also. It has to see the credit risk, it has to see the ESG scorecard, and how the SASB is representing it. The link matters in the materiality assessment because material assessment helps in identifying the ESG issue, which is most relevant to the company. You can focus upon a thing. जैसे एक company है, एक company के लिए आप the most relevant thing you can pick it up. SASB also provides a sector specific starting point, which is financially material. Once the material issue is selected, then the scorecard can help you. So first you have to use the SASB, then the scorecard comes. Put together, investor has to use both. SASB therefore informs us what goes into the scorecard. कि scorecard को क्या लगेगा, scorecard को क्या चाहिए. And the scorecard helps monitoring how well the company is managing. So it's both way. One needs other. Scorecard helps investor to go from, is the risk important? That is SASB's role. And how well the company is managing it is the scorecard. So lastly, what does that mean for valuation and the investment decision making? This is what actually it is meaning to for valuation and investment decision making. A company investor would like to know, what is the risk? Is the risk important? And how well the company is managing it is very important for any investor to suggest someone to invest this company, whether the company is ESG compliant or so and so score is available. So you better invest in this or not. This is all from my side, sir. Thank you very much for being a patient here. Any questions about it, you can ask.
Thank you very much, Rajni ji. Really appreciate that for your active participation and insightful contribution on SASB. Of course, all questions are welcome, but before we do go to question, let me just summarize it in few pointers, what we should be taking away from today's case study. First of all, let's have a fact clear. are you aware now SASB standard, which is in short of Sustainability Accounting Standard Board, whoever is using for materiality assessment, their accuracy has increased by 30% in ESG reporting. Okay. And that's why it is liked by everyone. Second reason, it is used by everyone in Europe as well as people who have exposure to Europe, because it provides you industry specific standards. So there are more than 77 industry which has been covered under this reporting framework. Rajniji has guided us on the importance of materiality assessment, and he also covered a part of scorecards and how an investor, a person who wants to make a decision in a company or a subsidiary, how they can use SASB standard. Now, more than 70% investor across world is considering ESG factor in their investment decisions. And specifically, they want people to refer SASB along with other frameworks like GRI. What we learned today was practical in nature. He has covered one real world example of jazz, if you have seen today. And these are the three key points which you should be taking out from this case study. First was ESG rating is a critical or crucial indicator today, and how well companies manage their environmental, social governance, risk and opportunity can be reflected well enough by framework like SASB. That's the learning number one. Learning number two is understanding and utilizing this standard can significantly enhance your transparency and decision-making process, where we were looking for the scorecard. When she covered the scorecard and started linking it with the SASB, she explained it really well. Company like Zaz, which she has covered, which is in marijuana, very risky industry, isn't it? We love such kind of industry, but it is a risky industry. How to put security, how to account that as a material topic becomes a topic of debate. But standards like SASB, if you integrate this formal structure, remarkable improvement in their ESG reporting accuracy and overall sustainability performance comes up. That is what we have learned from Rajni's case study. So thank you very much. And I see together we can make a significant impact today, Rajniji, on the world of ESG investing. And that's what the case study was. Now, let me welcome another guest, Subodhji, who is a specialist in ESG now, learning with, again, he is also there with us for a year now, and he practiced as a consultant with us and others as well. But his background is quite interesting. So let me invite him. Subodhji, you can share your screen as well as start your camera, so that will help others to know you. And you can start with your topic. Are you there? Sorry.
Good afternoon, everybody.
Good afternoon.
So, I will be presenting case study on one of the industries where the main purpose of this is how to integrate listed equities into the ESG and interpret how the specific disclosure is made by the company.
Can you put your screen full screen, because we are unable to see your full screen, unfortunately.
Okay. 1 second. Now it is visible?
Yes. No, again, I think it's you have zoomed in. You have to zoom out. Oh, okay, fine. I think everybody is able to see it. Done. Yeah.
Now it is okay?
Is this okay? Because I am unable to tell.
Yeah, it is okay.
Okay, go ahead, please. Yeah, go ahead.
Okay, na?
Yes.
I'll change little. So we are discussing about we are talking about the CFA ESG investing. Now it is, as Vivek sir has told that now it is sustainable investing. So we are going to cover in chapter number 7, second example. First example already Rajniji has explained you.
Subodhji, you need to put it in the screen mode.
She has also explained about the ESG scoring. So
you have to put it on the full screen mode again.
It is gone?
Yeah, now it is better. Go ahead.
Yeah. So ESG integrated into the listed equities. We have talked about the first two things. Now we are talking about interpret a company's disclosure on selected ESG topic. So how one company is disclosing is their ESG report. So how can we judge or we can give ESG score on that report on specific topic? So here we are going to talk about the cement company. So cement company, we are going to, if we go to the materiality map of the cement sector, so in the materiality map, there is a construction material is there. So there are 5 key materiality metrics: climate change impact, resource management, regulatory threshold and compliance, health and safety, business ethics and culture. These 5 are the major materiality concept there. So we are talking about now the construction chemical company. So screen visible. Na? So here we have taken ESG factor in materiality topic as a climate change. In climate change, we are talking about the GHG emission and carbon accounting, where the scope 1, 2, and 3 are. Why we have taken this? Slide is not moving. We go to full screen, slide is not moving. I don't.
Continue with this. It's visible. Go ahead.
Yeah. So now it's one. We will not talk about the exact name of the company. Now suppose cement company A is there. He wants to disclose this carbon mitigation strategy. So what company A has done? They have declared only scope 1 in their ESG report. So scope 2 and scope 3 is not there. So while one company B is there, they have neither disclosed scope 1, scope 2, scope 3. None of the scopes are declared. While company C is there, where they have declared scope 1 as well as scope 2, while scope 3 is not disclosed. While company D has disclosed all the 3, scope 1, 2, and 3. And all these data which they have disclosed has assured by one independent party. So they are the assured data. So how now one analyst is there, or if you want to invest in that company or analyze about the company's performance, ESG performance, how will you rate that company whether and decide whether you want to invest in that company or not? So this company A is disclose only scope 1 data. So how will you go ahead? So then following questions can be asked or looked into. So what is the size of company? Whether it is a small company or whether it is a big company. How many number of employees are there? What are their resources? How much is the market capitalization? So these you compare with the company A, B, C, and D, where all the scopes are given by company D, and this company has given only scope A, and company C, where they have given scope 1 and 2. So which scope is more important for them? So if the company A is declared scope 1 only, and it is not very much important, out of total GHG emission, if the scope 1 is only 10%, then the declaration of scope 1 is not much important. So if we cannot rate only from the scope 1 declaration. If the scope 2 is more important, then it should be declared, and scope 3. So when we go to the all this data from the related industry or their competitors, will come to know whether company A has declared scope 1 data is correct or not. Or if the company A is very small, it doesn't have resources to gather the data from scope 2 or scope 3 outside their premises, then we can tolerate. But if the company is bigger, they have a lot of resources, turnover is very high, then they should invest on collecting scope 2 and scope 3 data also. Now, here we are specifically talking about the cement industry. So, as I told you, how well this data is compared with the competitor data, whether this data is adequate, whether this data is comparable. Suppose you have data available of scope 1 about company C and company D. So, you can compare that scope 1 is higher or lower per ton of the production. How much is the scope 1 emission is there? Whether this data is authenticated by some agency or not, or this data is as per some standard, which protocol they have, which framework they have, GHG protocol or BARSR or some CDP. So whether these are, he has done this as per some standard or not, that also you can look into. Then next is what his business model suggests. Because as I told you earlier, whether scope 2 and scope 3 really matters for this industry. Suppose we are taking here example of cement industry. Here most GHG emission is from the scope 1 only. because that if we will go to the real data in next slides, we'll come to know the scope 1 emission is 8 to 10 times higher than the scope 2 and scope 3 together. So scope 1 is more important. So here in our case study, uh, only one industry which has given scope 1, cement industry 1, which has given only scope 1 is okay if you go by from the analyst point of view, because it is maximum data. 80 to 90% of GHG emission is from the scope 1. So this will do. Then the scope 1, suppose purchase input is there from scope 3. It's used by customer is scope 3, which is in downstream. So from the data, analyst will judge whether this is okay or not, assuming that scope 2 emission is equal for all other matters. Then suppose company A, cement company A in this case study is giving only case data of scope 1. So whether how long this company is been disclosing this data? Is this is a base year or it is disclosing this data for years together? And then how these data are consistent or reliable? What is the progress? Whether this scope 1, if baseline is suppose 2019 and this data is given for 2024, so 5 years are left. Whether there is a reduction in emission of scope 1 year on year, whether any future commitment has been done by this company for reduction in scope 1, or whether this company has done any commitment for declaration of scope 2 and scope 3 emission data and the reporting, and what is its future strategy for this emission reduction or making to net zero. So any narrative we cannot make without going into the scope 2, scope 3 and competitor data. So in this case, even though company has disclosed only scope 1, I think it is sufficient because it is contributing to the 80% of the GHG emission. And he has given the reduction plan in the report. So if we are getting all this questionnaire, one should ask to the company or the person you are interacting for this data. So if your answer is positive, then we can give better scoring. And how to give scoring, Rajni already explained you. So scoring of this year cannot be below 5 out of 10, cannot be below 5, even though he has only given scope 1 data, because in cement industry, scope 1 data matters more. So scorecard method, or either you give better valuation to the company and adjust this data in their valuation. So I am giving the now live example of the cement industry which is available. So there are so many 5 industries I have taken: Holcim, Ultratech, Sri Lakshmi, Ambuja, and SEC. So Holcim is the world number 2 cement industry, and it is not in many more construction chemical products. So its turnover is this all data rupees in crores, and number of asset value is also given, employees given. So this is how you give the score to this industry. So that's why I have given this example. The Holcim is there, Ultratech is world number 5 and number 1 in India, and that turnover is given, asset value is given, and employees are given. So from number of employees, per employee, how much turnover is there, from investing so much amount, how much turnover they have done. So from all this data, we can judge and we can score the company. So competitor data, the importance of showing you this slide is, from the competitor data, you can judge whether company is performing good or not. So this is only financial data, and we'll go into GHG data also for this company. So they are the 5, there's something. And from their ESG report, we will judge whether this company is really interested, really incorporated ESG into their report or not. One second, huh? This slide is not moving. So now I show the example of out of these five, C Cement is the smallest company. From their environmental, social, and government data book for 2023-24, what they are saying, they are setting target that reduce net specific scope 1 emission by 12%, reduce scope 2 emission by 27% by 2020, and they have taken 2019 as their base year. They have taken that zero waste to landfill, zero injury, zero discharge every year. All those things are not important. We are here talking about the GHG emission and carbon mitigation strategy. So first two, scope 1 and scope 2 is important here. There they have taken the target, but they have not given the actual data. What is their emission in the current year and what was the base year? Only they have given the percentage. And then how will they reduce? Those things are also not given very soon. Also, they have taken environmental target on their page 9 that this was a GHG emission in their scope 1, this was their GHG emission in scope 2, and total what is the non-renewable energy consumption. All this data they have given, which is a base data, and they have taken target for this year. Actually, they have misinterpreted in their report. This is actual data for the year 23. By mistake, they have written as a target. But baseline comparison, how much reduction actual taken place by the year 23, they have not given. They have prepared report on task force climate related based on TCFD framework also. There they have included scope 1, scope 2, scope 3. They have written, but actual data of scope 3, they are not shared here also. Same thing which is given in the earlier report, they have shown that GHG emission, they will reduce by 12.7% per ton in cementitious material and GHG emission, scope 2 emission by 27%. And this target they have taken based on the SBTI initiative, Science Based Target Initiative, which is one of the framework. Now we'll go to the one of the best company, Holcim. They have presented 2020 how this report is compared with the Sri Cement. That is the idea of showing this report. So here they have shown scope 1, scope 2, scope 3. They have shown base year as a 2018. What was actual emission? What is the emission in year 2024? What is their target is in 2030? And what is their target in 2050? All data they have shared, and those data are available, and they have told that they are going as per the target smoothly. So, and from data also you can judge whether they are going as per the target or not. So they have taken all three scopes, and that target are also science-based targets are there. Now we'll go to the Ultratech Cement. This is also one of the world number 5 company and number 1 in India. They have shown that they have taken climate change reduction, 12% reduction in CO2. What they have achieved in this year, they have shown 22% electricity reduction, 485 they have greenfield. They are following circular economy. They are having water stewardship, and their ESG rating also they have given as per the different agencies. And their main is CRISIL ESG score is 57. ESG rating from MSCI is a B. So they have not only shown the data, they have given the rating as by the ESG agencies also, ESG rating agency also. Now here they have shown snapshot of the GHG emission. I am showing scope 1 is 712 million. The scope 2 is 18 lakhs. Scope 3 is 18. As I told you, if you total scope 2 and scope 3 addition, scope 1 emission is 7 times higher than scope 2 and scope 3. So this is the precise point where we are talking about the company A, which has given only scope 1 emission, because it is 7 times higher than scope 2 and scope 2 emission. And if all total emission, this scope 1 emission is around 80 to 82%. So if you only account for scope 1 emission and take steps to reduce scope 1 emission, also it will suffice for cement industry, because scope 1 is most crucial. So here Ultratech Cement is year by year they are reducing scope 1 emission from 582 per ton of the cementitious material. They have gone to the 556 by 2023-24. Now we are going to Ambuja Cement, the second case study, which is number 2 company. Now Ambuja Cement and ACC Cement is combined, and Adani Cement has taken over both the companies. This was they have taken Holcim share only. Holcim and Lafarge share was there here in Ambuja and this. So here also in their report, they have shown what is their commitment about ESG. They have shown net zero when they will achieve, water positive, their carbon emissions, renewable energy, plastic negativity, clinker factor, all these things related to cement industry and overall they have shown. And here see, as you see, we are talking about the GHG emission scope 1, scope 2 and scope 3. Scope 1 emission there is 73% of the total emission. So even if you praise or focus on scope 1, it will suffice. Scope 2 emission is hardly 2.98%. Scope 3 is at 23.91%. So this is figures are given of scope 1 emission and how it is 10%, 73% of the total. And their journey from 2021, 23 and 23, 24. All these figures they have given. So this addition, the increase in scope 1 is there from 2021 because they have taken over some companies and their addition of some of the units. So that's why there is an addition in the capacity also, and that's why GHG emission is reduced. But in 23, 24, it is reduced from 200 million to 1400. So many steps for a reduction of scope 1 emission. What are the steps? They will improve energy efficiency. They will use alternate fuel. They will substitute thermostat, and they will develop new low carbon products. All these ways they will improve their scope 1 because scope 1 is a major scope. How will they will improve energy efficiency? Those steps are also they have given. See, more important is here, if you go to ESG scorecard, they will talk about what incentive they are giving to the employees or senior employees so that they will focus on the GHG emission. Unless until you give some benefits to them or if they include this reduction target in their KPI, this will not be able to achieve. So if you see here, their CEOs, they have included in KPI reduction of absolute GHG emission, and they given the monetary incentive for that. Not only in CEOs, they have included in CFOs KPIs also and CEOs KPI also. So if you want to really achieve your target, you have to include those target in the KPIs of the senior most persons of the industry. So here CEO, CFO and CEO, all the three this KPI, they have included the GHG emission target and how much monetary benefit they will give it to them is also included here. So this was all about the scope 2. GHG emission. Example 2 of case study.
Thank you. Thank you very much, Subodhji. We are running out of time. If you may allow, let me go to Bhaskarji and we will come back to you again. Yeah.
Okay.
Thank you very much. Let me summarize what all has been covered. A lot of data points, a lot of insights. What a explanation that how to judge e-disclosures, which really means something whenever you do analysis, ESG analysis or integration of ESG in a business. What Subodhji has covered today, of course, has highlighted three facts very clearly. First, there is the importance of ESG disclosure in companies like cement company, where a scope 1 emission is 7 times higher on an average to the scope 3 emission. Generally, we know, right? Scope 3 is the massive emission factor. But here in cement factory, steel factory, it is exactly opposite. Environmental disclosures are crucial. That's what Subodhji has established today for transparency and operational efficiency. Companies with a strong environmental practice can reduce their operational cost, which we have seen when we were comparing Holcim Cement, Sri Cement and Ultratech Cement. Just to give some numbers in perspective, I don't know how many of you can recall those numbers. So without going and jogging your memory, let me give you that number in gist. He talked about Holcim and he listed their asset and revenue. You know, they are making more than 2,75,000 approximately crores of rupees as a revenue across world. But have you watched there only 65,000 people? When you compare the same thing for Ultratech, the number has been reduced. Revenue number, of course, is not to that extent, it is 1/10 of that number, which is approximately 68,641 crores of rupees as a revenue they are logging, but they have 23,000 people. If somebody is doing financial analysis on this company, they will find it out that company B is much more efficient than company A. That's the finding. Holcim Cement, international company, German company, has per employee basis, they are making 43 units of or crores of rupees, 43 crores per employee. And that's why they pay really good in those company. But when you come to Ultratech, you see here each employee is earning only 2 crores rupees. Why? Because 68,000 crores of revenue, but they have 23,000 people, right? So you will discount Ultratech in this case if you are only considering financial analysis of that company. And here the game changes, and Subodhji has changed the gear going to their sustainability report. And he talked about two more things there. Of course, he talked about Sri Cement as well as Ultratech Cement. And what was striking, that carbon emission by Holcim is massive. You saw those numbers, scope 1 and 2 numbers, right? They were in 14 millions. Means 14 million plus you have 589,000. 14 million tons was carbon dioxide equivalent was a scope 1, 589 was a scope 2, and 4.728 millions of carbon dioxide emission was coming from scope 3. Again, the same situation which we talked in earlier, 80% is coming or 70% is coming from scope 1. But the striking fact was these guys, even though they have German technology, somehow the numbers suggest on per capita basis, per employee basis, these guys are emitting, to be exact, 1,378 tons of carbon dioxide per employee basis. Strikingly, Ultratech is doing half of that. Will you not love Ultratech in that case? Right? They are consuming approximately 859 tons of carbon dioxide emission when they are producing cement. So it's not always you should go with a glorified multinational company's emissions. You should also consider the data specifically when it comes to looking into e-disclosure. And that is why when you are navigating in emerging market, look for such data. Do not only rely on financial analysis, as otherwise you will be doing half-cooked job. Isn't it? This is what your message was.
So, sorry, I'll just add. So, in one slide, I added the question which we should ask while analyzing the data, and the answer of those data will judge the company whether it is performing well with the competitors or not.
When we will start the next session, we will be doing that. Thank you very much. Okay, let's go to Bhaskarji, who used to work with company like Ceasefire, a very famous fire extinguisher company you must have seen in all the cars. And now today you will see him, listen him on his case study. So let me welcome Bhaskarji. You can share your screen now.
Yeah, good afternoon. And this is Bhaskar, as the introduction is already given by Vivekji. I will just straight away get into it. It's going to be more of a live calculation of the discounted cash flow analysis. So, Subhaji, is that, Vivekji, that's correct. We are going to do that live, right?
Yes, absolutely. Let's show them that how we integrate in valuation these numbers.
Yes. So basically what we are going to do
qualitative and quantitative both. Yeah. How we are
both
integrating
yes,
ESG factors. Let's go ahead.
Okay. Everyone can see my screen? My screen is visible? Vivekji, my screen is visible?
Yes.
Yeah.
Yes, we can see your screen.
Okay,
Yes.
okay. So we are going to take a case where if the company faces a significant environmental regulations or the litigation, its future cash flows can become impaired. So the investor would factor the potential cost of these risks, that is the ESG risk, into his cash flow projections. Lowering the company's valuation in a discounted cash flow analysis. It also works the other way around. In case if the company is well positioned to benefit from a ESG operations or ESG opportunities, such as selling their own products to reduce the customer's electricity usage, that could boost future cash flows through high revenue growths, increasing the value of the company's equity determined via DCF analysis. So we will take the case. The first case is going to be more of a base case, which means it's not the discounted, it's going to be the base figure, which we are going to talk of as an example. So the revenue projections for this case study that was taken is to start with the last 12 months is going to be 28,156 euro in millions. Now the forecast that is given is that this is going to increase by 5% every year. Into 5%. Yeah. So it's going to be every year the revenue gets increased by 5%. That is what is given in this example. That's the growth that the company is showing. Now the projections of the operating expenses that is given, which is generally it's about 65% of the revenue. Now these are the revenue forecasts. Terminal value is going to be 0 till the cash flow comes in. The income tax expenses is 24%, which means it's going to be revenue minus operating expenses into 24%. It is 2,365 that is applicable everywhere. So it is income tax expenses, 24% is what in this example we have taken. And we are looking at the capital expenditure, which is forecasted at 15% of the revenue, which is 4,223 in the last 12 months. As it goes, then it comes to 5,390. Now, if you look at it, revenue growing by 5%, the cash operating expenses is 65% is what is forecasted for the next 5 years. Income tax is about 24% of the net of the operating expenses. Capital expenditure, which is 15% of the revenue, which has been forecasted, and therefore what is available for the cash flow to be distributed to the investors is what we are looking at. Minusing all these expenditures, it is 3,266 and goes on to 4,168 in the 5th year, right? Now, the discounted cash flow, which is given as a forecast in this, is about 10%, is what as a base, which is given 10%. I have to minus this, minus 2,939. Now this would go like this. So the discounted cash flow which is given in the projections is this, and therefore the terminal value which is being forecasted for this company is 46,779, of which the discounted is coming to 29,046. So if you look at it in this example, the valuation which is done is 49,000 040 is the overall cash flow, discounted cash flow. Discounted cash flow, the total comes to 49,040. This is the base calculations based on the forecast that is given in terms of the percentage basis. Vivekji, is that fine?
Yes,
Anything on this?
absolutely. Yes, absolutely correct. This is how you establish the base case. Just add it
Yes.
up and show them that this is the projections which are happening there.
Absolutely. Now we can look at the case from the base to the discounted, case, how it is being done, where this ESG factors basically when it gets affected. See, investors basically will look for two kinds of, the parameters. One is the whenever there is an ESG factor is a matter of concern, then they do the reduce their revenue projections based on the government policies that subsidizes alternatives, alternative renewable energy sources, and electric alternatives for transportation. The forecast might factor in various scenarios for the pace and the impact of the policy.
If you can write them down, it will be easier for people to visualize that these are the ESG factors which we incorporate into the base case. And
Yeah, absolutely. So what we can do is, one is reduced revenue projections based on government policies. Government policies. That subsidizes alternative renewable energy sources and electric alternatives for transportation. So this is one factor. The second factor is increase the discount discount rate to account for the increased sector-wide. It differs from sector to sector, so you have to consider this volatility in future cash flow projections. From unpredictable climate change. So these are the factors investors would always look at bringing into that cash flow projections. So they do the valuation. If the company is not doing good in the ESG factors, then they do the discounting factors. The company is doing good, then they may be increasing the factors, the discounting factors. They get a better. So let's look at, I'll take the same examples. Now, what we can do is the revenue projections, what is code here, will keep going down in the discounted factor. That is, let's say in the given example, what we are doing is it goes from 5% from the previous year, which is in the subsequent year, which was there, is goes down by 3%. It goes down by 2%. It goes down by 1%. And it goes down by minus 1%. X to 4, 30,461. 71,300. Yeah. So here you can clearly see the revenues factored by the investors is minusing from a 5% forecast to 3%, 2%, 1, minus 1%. This is the discounted factors. So therefore, the 65%, which is the operating expenses, will also eventually will have an impact. In the case of income tax, as we said, 24%, this minus operating expenses into 24% is 2,365, and apply it on the reduced, the net of operating expenses. And therefore, because of the revenue reductions, your capital expenditure, which is forecasted at 15%, also on this reduced revenues, so that your cash flow is discounted for. So what is net available for the distribution to the investors is this minus this, minus this, and minus this. So the net cash flow available is this. Therefore, the discounted cash flow factor is this into 10% minus. This into 10%. So the discounted cash flow factors, you can see between what was available in the previous base case vis-a-vis to this is into the reductant factors. Now, in the case of the terminal value, 34,759, and here it is 21,582. Therefore, it makes it as a total discounted cash flow available as 40,547. That is the net available of the discounted cash flow. Now, this, if you look at it as I explained it, this is the base in which generally the cash flows are worked out. But moment when you bring in the ESG factors, and when the company is not doing or making use of the opportunity of the ESG factors, then the investors start looking at factoring the discounted on the revenue projection. Therefore, it ultimately affects the cash flows. Therefore, while doing the company evaluations, you can see it was 49,040 euro millions as compared to 40,547. This is how the discounted factors are considered by the investors when the ESG factors is not taken into consideration. This is what it is. Vivekji, is this fine? Is this right?
Absolutely, absolutely correct and well summarized. A very difficult topic in general, um, very simply summarized. Now, team, have you seen what exactly he has done? He has shown you that if you consider ESG, a stock can plump by 20%. 49,000 was the value in crores, drop to 40,000 by 20%, 18 to 20%. Can you imagine 18 to 20% overvalued company we are buying? Yeah, if we are not considering the sustainability, account for the same. And that is why I called everyone, whoever is interested in this field, to join in today and learn from not only a mentor like me, but we have a group of mentors and consultants who understand the field. Thank you very much, Bhaskar ji, for the active participation and insightful contribution today. Let's continue to
Thank you
drive
so much.
positive change going forward. Simplifying this stuff so even common person can understand, relate, and make career and consulting business out of it. If anybody has any question, we are opening the session for question and answer. But meanwhile, let me summarize what exactly Jayasankar ji or Jayasekhar Bhaskar ji has completed just now. As we conclude DCF modeling, case study, he first covered that importance of ESG in DCF, and he covered two areas where you can make those changes. He covered in the revenue side, where we talk about 5 steps of materiality. Of course, materiality was covered by Rajni ji and later by Subodh ji as well. Then we looked into that even though the financial model accounted for 15% increase in valuation because their revenue is supposed to grow. But when we accounted for ESG, the valuation actually dropped by another 3-4%, means 18% in total. Yeah. So if person is doing a financial analysis, not considering such kind of silly stuff, he is making a mistake of their life. Even though you are joining as a sustainability consultant, be worried about it. Your money is not coming into your pocket because that company is not going to do very well. Second, and the reasons were, of course, he has considered all that reason that compliance issues, subsidize renewable energy to the competitor like Adani is getting, right? Practical ESG integration, which Bhaskar demonstrated today, was the approach a consultant or investor like us do that all the time, right? In the green bond calculation, which we are learning in the last session, or even in equity consideration. ESG integration approaches requires you to adjust in revenue, adjust in cost, and as well as into your asset productivity. And as we have seen in the previous session with Subodhji, Ultratech and Wholesome company, even for their emissions versus financial return, all those need to be accounted for. And this is how our live flipped class work. Flipped class means I am not teaching all the time. It is they themselves who are doing a deep research. Trust me, it is not there in the curricula. Do you believe a US book will cover Ultratech, Sri Cement? Do you believe that case study which Jayasekhar Bhaskar ji is doing was covered in that book? No, he is bringing the practical insight because tomorrow when he is going to do the practice, he's going to do the practice here, right? And he cannot use those kind of some large project reports to explain his client. And that is why this flip flop system with live case study, which we do all the time, specifically in the case of some abstract topics like ESG integration, valuation, which you as a sustainability officer or a safety officer or a consultant might not be even thinking about it, but you can use it at your advantage to make even GHG protocol as a profit center, sustainability as a department as a profit center, right? So let me conclude now in this live session. Of course, there are a lot of things are pending with G as well as myself, but we are going to cover that later on. This was just a showcase class to you guys. In today's live session, we have explored practical application and real world example like a company which is in bad industry. If you put a screen, ESG screen, Anchika understands, right? We will be rejecting it. It's in weed harvesting. But of course, the purpose is for, or you can say it was cannabis, right? Not weed. So it was cannabis. The purpose was to produce medicine. But there is a requirement which if they are not fulfilling, they are not fulfilling the ESG requirement and hence they can be penalized. And how to use SASB framework like SASB to cover yourself that eventually such kind of company who had a better purpose, but process is difficult, still can justify and get a better rating. That's what we learned there with Rajni ji. When we looked into Subodh ji, discussion where e-disclosure and assessing how to incorporate environmental factor into your business decision making, we looked into that how operational efficiency improvement by 20% in the case study which is there in book and by 200% because 859 versus 1400, right? That was the number per employee voice carbon dioxide emission equivalent was different. Can you understand? 100% change in carbon dioxide can decide a investor, can help an investor or decision maker to decide appropriately. When we went into DCF model, we did it live. We calculated all that amount, applied it on the projection like every year. He started with 5% reduction in revenue, then he reduced to 3%, knowing that they will be penalized. So they will improvise And that is why the growth or the penalty will reduce slowly, right? And it went up to 1%. So by participating in our program, which you did today, thank you very much, Mr. Harshil, all of you, Ramesh ji. Ramesh ji, you are also going to present with Anshika next time, right? That's what we are expecting. Who works in AT&T, don't you? With Anshika, you are going
Yeah,
to present the other case.
yeah. I haven't got the case study
Okay.
topic.
It will be
Yeah.
allotted. Even Anshika has not attended and no case was allotted, but she is doing on financial market because she has that experience specifically in the fixed income. So she is doing that case study along with you. So Ansu, JB, Govardhan, Rakesh Mahapatra, I hope you must have got some benefit, some understanding of some abstract concept in sustainability, which a lot of people get afraid of and not pursue international certification and join our smaller programs. So we encourage that participating in program like this, not only you will elevate your career, but you will mark a point in the world, right? People will know you. There are only 40,000 practitioners of ESG investing. And if you want to make a career in this area, there is nothing better than pursuing CFA Sustainable Investing Program. Yeah. And transform these vague topic into practice. Always learn by practice, which today evening in GHG, a 2-day webinar, we are going to do the same. We are going to practice all the concept we'll learn through the practice so that you not become a leader, but you become that steward which we need today in sustainability. That Galileo in Roman Empire, which is in Trump Empire, who can still survive and make a better world. Yeah, responsible business practices. And this experience is different. I hope everybody has found out that. If you found out that difference, join in evening 7 o'clock session, which we are conducting on GHG, and we will be looking forward your contribution there. Thank you very much, everyone. See you in evening 7 o'clock. Whoever has joined the program. Otherwise, nice to have you today, and I hope it helped. Bye-bye. Take care.
Thank you so much. Bye-bye.
Thank you. Thank you, everyone.
Thanks a lot.
Bye-bye.